All right, let's talk about a real head-scratcher in the health tech world, Phreesia. They just dropped a quarterly report that, on paper, looked absolutely perfect. But the market's reaction? Yeah, it was, let's just say, not great. In fact, it was brutal. So what in the world did Wall Street see that made a seemingly perfect quarter look so bad? Let's dive in. So this is the big mystery, right? Phreesia hits this massive milestone. I'm talking actual, real profitability for the first time ever. They beat on revenue, they beat on earnings, they even raised their guidance. So why on earth did the stock just crater, dropping 13% in after-hours trading? The answer, it turns out, is all in the timing. The entire story, from hero to zero, played out in just a few short hours after the market closed for the day. Let's walk through it. You can see the wild ride right here. The call starts, and at first, investors are happy. The stock ticks up a couple of percent. But then, just a few hours later, it's a complete bloodbath, down almost 13%. Something on that call completely spooked them. Let's start with the good news they heard first.
And let's be super clear, the good news was really good. This wasn't just a little beat here and there. It was a blowout across every single key metric that matters.
This is the headline number, a profit of 1 cent per share. And we're talking GAAP profit here, the strictest by-the-book accounting. They are officially, for the first time in company history, in the black. For a growth company, that is a massive, massive milestone, especially when Wall Street was literally betting on them to lose 7 cents. And the top line was just as strong. Revenue popped up over $117 million, growing at a super healthy 15% clip. So another clean beat against what the analysts were expecting. The good news just kept on coming. This chart right here, it really shows you the power of their business model. We're looking at adjusted EBITDA. It's just a common way to see how profitable the core business is. And look at that jump. It more than tripled in just 1 year. That's proof right there that as they make more money, their profits are growing way, way faster. That's exactly what you want to see. And the best part, a huge chunk of that growth came from their most profitable engine, Network Solutions, which was up a staggering 25%. So let's recap. Profitability? Check. Revenue? Check. Operating leverage? Double check. It was a picture-perfect quarter. So I'm going to ask it again. What on earth went wrong? Well, it turns out on that very same earnings call, management dropped another little bombshell. A very big, very expensive bombshell that just flipped the whole script for the night. They announced they're buying a company called AccessOne. Now, AccessOne is a big deal in patient financing. They help people figure out how to pay their medical bills. And strategically, you can see how this fits, right? It totally bulks up what Phreesia can do in the payments world. But it was the price tag that gave everyone sticker shock. $160 million. Think about it. You're an investor, you're just celebrating the company's first ever tiny profit, and then you hear they're spending a massive pile of cash and taking on new debt. Yeah, that's going to raise some eyebrows. And this slide really lays out the dilemma investors were facing that night. On one side, you've got this absolutely flawless quarter, discipline, profits, everything you could want. But on the other side, you've got this huge acquisition that throws a bunch of new question marks into the mix. How will they integrate it? What does this do to their balance sheet? And wait a minute, why didn't they raise their revenue guidance after this deal? It was that uncertainty that just slammed the brakes on the stock. Okay, but here is a super important detail that I think a lot of people just glossed over in the panic. The CFO, Balaji Gandhi, he said this very clearly on the call. The number one fear with a business like this is credit risk, right? What happens if patients can't pay their bills? Well, he made it crystal clear. That's not Phreesia's problem. They are not taking on that risk. Their partners handle it. That is a game-changing distinction that the market seemed to miss. All right, so let's zoom out for a second and try to see what management is seeing. Because this deal, and this other story that's bubbling up around AI, it's all part of their long-term vision for the company. First, just a quick refresher on TAM. It stands for Total Addressable Market. Basically, it's the company's way of saying, this is the size of the entire pie we're trying to get a slice of. And just look at this. With this AccessOne deal and their other growth areas, Phreesia thinks its TAM just went from $10 billion all the way up to $24 billion. They've more than doubled the long-term prize they're chasing. See, this is management playing chess, not checkers. And the other massive piece of this long-term puzzle is AI. They've rolled out a new voice AI product. And listen, this isn't some pie-in-the-sky science project. They confirmed on the call that clients are already using these AI tools, and this is the key part. They're already monetizing them. They're making money from it right now, and they think it's a massive opportunity.
Okay, so that brings us to my favorite part, the next call. Given this huge gap between a great quarter and a terrible stock reaction, if you're an analyst, how do you even think about trading this situation? The first idea is what you might call a buy the dip arbitrage. It's basically a bet that the market has gotten something fundamentally wrong, and the price will eventually have to correct itself to reflect reality.
So the play is pretty straightforward. You go long the stock. You're betting that Wall Street will wake up and realize this AccessOne deal isn't as risky as they first thought. Now, here's the outrageous twist. You could also sell what are called covered calls. Because everyone is panicking, the price you get for those options is super high right now. It's basically a way to get paid to wait for the market to come to its senses.
The second idea is a bit different. It says, forget about the short-term acquisition noise. Let's focus on the real long-term story here. And that's a leveraged bet on the game-changing potential of their AI strategy.
So here's how you'd approach this. Step 1, you just have to look past all the M&A drama and focus on the fact that they are already making money from AI. Step 2, you're making a bet that these AI tools getting embedded into what their clients do every day is going to create a massive new river of revenue. And step 3, instead of buying the stock, you could use a more advanced options strategy to get that leveraged exposure to the AI story without putting up as much cash. So wrapping it all up, our final rating for PHR on the next call is an outperform. Look, the market's reaction just feels like a major overreaction. We see a real chance for the stock to get re-rated higher once investors really digest the details of the acquisition and, more importantly, start to price in this huge, already monetized AI opportunity. And of course, we always have to say it, this has been an educational breakdown. This is not financial advice. Please always do your own research and talk to a professional before making any investment decisions. That's it for this one, and we'll see you on the next call.